Everyone is talking about GST cuts, but let's know the real story. The government is firing up on all the cylinders. First, we had income tax cuts, now GST 2.0, and also the repo rate cuts. This clearly indicates that the government is trying to push consumption and kickstart a new growth cycle. Sectors seeing the biggest GST cuts: apparel and footwear between Rs 1000 and Rs 2500 are down to 5% from 12%. Cement is down to 18% from earlier 28%, and consumer durables like ACs, refrigerators, and TVs are also down to 18%. On the services front, hotels, the GST rate is down to 5% from 12%. Salons, gyms, yoga services are now down to 5% from 18%. Durables like ACs and hospitality industry now have double benefits. First, from the GST rate cuts, and now as discretionary expenditure increases as households now have surplus money. Insurance is a mixed bag, although the rates got slashed to nil, but the removal of ITC benefits has neutralized the positive impact. Beverages, yes, GST has increased to 40%, but the removal of the SAS has made sure that there is no loss to the industry. Here is the kicker: the rate cuts are targeted at the lower income strata and the mass market rather than for luxury goods. The real winners are the middle class and the lower middle class, who now have surplus money as they suddenly find essential goods and services cheaper. Stating some more second order impacts: retail banks and NBFCs are expected to face increased credit demands. Cement and infra upticks, reduction on renewables GST is going to push the infrastructure growth to new levels. So, while the headlines say GST cuts, but the truth is India is engineering an economic hat trick: cheaper loans, lower income taxes, and higher consumption. And this is going to come from the lower ends and the middle of the pyramid, not the higher end of the income groups. If you want to know the best sectoral picks, reach out to us at Pravin Ratilal.